The stock market is currently closed for the weekend and the Independence Day holiday observation. The latest closing price for Rivian Automotive Inc., trading under the ticker symbol RIVN on the NASDAQ, was $18.63 as of the final whistle on Thursday, July 2, 2026. During that final trading session before the long holiday weekend, Rivian experienced a massive intraday surge, climbing 8.44%, which translates to a clean $1.45 gain per share from its previous baseline. The stock showed immense trading volatility throughout the day, hitting an intraday high of $19.79 after opening the session at exactly $18, while dipping to an intraday low of $17.12 before the bulls aggressively took control. Trading volume absolutely exploded during this session, with over 78 million shares changing hands, which is more than double the company's recent daily average. This sudden burst of energy has caught a lot of macro analysts completely off guard, especially those who had written off the brand as a cash-burning experiment, unable to scale up production. While the broader public narrative suggests that young electric vehicle manufacturers are facing an impenetrable wall of consumer fatigue and high interest rates, the actual numbers coming out of their Illinois assembly plant present an entirely different story. Management surprised the street by officially raising its full-year delivery guidance for 2026 to a range between 65,000 and 70,000 vehicles, up from their prior conservative estimate of 62,000 to 67,000 units. This subtle upgrade is a massive deal because it suggests that the production bottlenecks that plagued their manufacturing lines for quarters are finally clearing out, proving that internal efficiency is moving faster than the overarching market skepticism. When you look at what people expect from this company versus what is actually happening on the ground, the friction between narrative and numbers becomes glaringly obvious. If you open up your Robinhood app or check trending symbols on typical investing sites, the general consensus among retail traders has been one of extreme caution. For a long time, the expectation was that legacy automakers would simply overwhelm smaller players with their massive balance sheets, or that dominant giants would capture every single buyer looking for high-performance, clean energy transport. This expectation created a prolonged short interest environment where people shorted the stock down to its 52-week low of $11.57. But the reality is that the premium utility segment is showing an unexpected layer of brand loyalty that mass-market sedans just do not enjoy. People using basic Robinhood stock trading tools or managing an individual brokerage account often lump all electric vehicle startups into the same bucket, assuming they will all face the same fate of delisting or restructuring. The reality that emerged this week is that their second quarter deliveries handily beat the consensus estimates by coming in at 12,194 vehicles against a predicted 11,000. This outperformance creates a major curiosity loop for anyone involved in self-investing because it highlights a business that is successfully decoupling from the generic sector downward trend. This massive volume spike and the subsequent price appreciation on Thursday cannot be looked at in a vacuum. To understand the momentum, we have to look at where institutional capital is moving across major indices. Investors who traditionally pile all their capital into massive tech enterprises like Nvidia stock or Apple stock are beginning to look for deep value plays where the valuation has been compressed to the absolute extreme. When a stock like Rivian loses a significant portion of its peak market capitalization, it starts popping up on automated algorithmic screeners used by institutional capital managers. During the recent daily swings, we noticed a sharp increase in block trades, which typically signals that large funds are quietly building positions rather than everyday retail buying. Sector momentum has been incredibly hostile over the last year, with high financing costs making large vehicle purchases difficult for the average household. Yet, while general interest in electric options has softened globally, the specific demand for rugged, high-end adventure vehicles has remained remarkably resilient. This creates an interesting dynamic where the stock has been beaten down due to macro anxieties, while the specific operational metrics of the business are ticking upward. For anyone managing their own financial choices, whether you're using automated platforms like Schwab Intelligent Portfolios or executing direct trades on a specialized Fidelity trading platform, analyzing this divergence is essential. The trend toward online investment and online investing has made it easier for individual market participants to access complex corporate data, but it also creates an echo chamber where negative sentiment spreads rapidly. People looking for investment help often look at dominant names like Tesla stock to gauge the health of the entire clean energy transportation sector, assuming that if the industry leader is cutting prices, a smaller firm has zero chance of survival. But this line of thinking misses the structural differences in product mix and target demographics. A consumer looking for a dedicated off-road utility platform or a customized commercial delivery fleet is not looking at a standard passenger sedan. By focusing heavily on the technical trends and ignoring the specialized product niche, many self-sufficient investors missed the quiet accumulation of shares that occurred right before the guidance raise. This demonstrates how a self-investing strategy requires looking past the daily noise on popular investing sites and looking directly at factory output capabilities and localized demand. We can gain further insights by examining how the largest asset managers handled these positions within their broader index funds and active portfolios. Institutional tracking data shows that prominent institutions managing Fidelity investments and large Fidelity mutual funds have maintained substantial core holdings in the company, often balancing them within diversified clean energy buckets. When a company manages to exceed its delivery expectations, it triggers a re-weighting mechanism across various Fidelity ETFs and broader institutional baskets, creating a baseline of buying pressure that supports the equity during broader market sell-offs. For individuals managing their own retirement setups through specialized vehicles like Fidelity IRAs or utilizing the convenience of a Fidelity mobile app, seeing this institutional stabilization provides a completely different perspective than the chaotic charts visible on a standard retail individual brokerage account. The stability of institutional backing suggests that while retail sentiment is incredibly fickle, the professional capital managers are looking at a multi-year horizon where manufacturing capacity and proprietary architecture hold immense tangible value. This professional conviction is a critical counterweight to the short-term speculative trading that often distorts the true health of the enterprise. To execute sophisticated trades in this environment, seasoned market participants often rely on high-powered tools like Interactive Brokers platform to analyze order book depth and short interest data. Looking at Interactive Brokers stock trading metrics, the cost to borrow shares had been ticking up significantly over the past month, indicating that short sellers were becoming increasingly crowded in their positions. When the positive delivery report dropped, it created a classic short covering rally, forcing rapid buying that pushed the price well past immediate resistance levels. Similarly, tracking activity across modern financial networks like SoFi Invest or standard SoFi investing accounts reveals a sharp pivot in sentiment. Retail investors using the SoFi active investing options or viewing data through the SoFi trading platform shifted from a defensive posture to an accumulation phase as the stock broke through its near-term moving averages. Whether you analyze this through the lens of premium Interactive Brokers fee structures or simple fractional shares tracking on a mainstream app, the mechanical reality of the market remains the same. When a heavily shorted stock delivers an unambiguous operational win, the upward velocity is amplified by the structural design of modern trading systems. Comment below how many shares of Rivian Automotive you currently hold, or if you think the premium electric truck market is hitting a structural ceiling. Hearing your direct perspective on whether you would personally purchase an electric utility vehicle at current price points helps ground these abstract market figures in real-world consumer behavior. To fully understand why this expectation versus reality dynamic is so powerful here, we have to look closely at what this company actually does and how its core business model operates. They operate as an integrated automotive designer and manufacturer, focusing heavily on the premium consumer truck, sport utility, and commercial delivery spaces. Their flagship consumer models, the R1T truck and the R1S USV, are built on a highly adaptable skateboard architecture that integrates the battery pack, drivetrain, and suspension into a single modular unit. This structural design allows them to maximize interior space and maintain exceptional